Good afternoon, everyone. We'll go ahead and get started. Thank you for joining today's earnings release update for Hela Holdings, covering our third quarter results. My name is Adam Collins, General Manager of Corporate Affairs and Investor Relations. And I'm also joined by our Group CEO, Mr. Jalanka Janadasa, Group CFO, Louise Ramanji, and Group Finance Director, Juan Fernando, as well as our Group Deputy General Manager of Corporate Finance, Savindia Tessera. To outline the agenda for today's call, we'll start with a brief presentation of about 15 minutes, focusing on the latest financial results, which were published yesterday. We will then move on to a Q&A for the remainder of the session. Questions can be shared through the Q&A box on your screen, and we would encourage you to send in these questions during the call, but we also take them at the end. And if at the end we can also, you can raise your hand and we will unmute you to ask any questions that you may have. Just checking before we start, we might have a question. Okay, no, that's okay. So we'll jump into it. Just before I start, a quick disclaimer on forward-looking statements. Any such statements are based upon the management's current reasonable expectations and assumptions and are subject to known and unknown risks. Given the risks and uncertainties that may cause the company's actual performance to materially differ from that expected or implied by these statements, we advise you not to place sole reliance on them. We also do not undertake any obligation to update these statements to reflect future events or circumstances that may arise. So to move on and jump straight into the presentation, this initial slide shows a snapshot of the quarter's results. So as this demonstrates, it was an exceptionally challenging quarter for the company, and that's primarily due to the deterioration in the economic conditions among our key markets. So while revenue was up by 45% in rupee terms to 21.8 billion, this entirely reflects the depreciation of the currency during that period. In US dollar terms, which reflects the underlying performance of our export sales, revenue was down by just under 20% year on year. And this was really the result of a significant softening of consumer demand conditions in our key markets. That was not unexpected, though it was perhaps not a bit sharper than anticipated. But on top of that, we also saw elevated inventory levels among major apparel brands, also contributing to the issue. And that really comes off some slight over-ordering as a result of the supply chain disruptions we saw earlier in the year and the previous quarters as well. So that also contributed to this impact in the quarter. So the drop in USD revenue, as you can see on the slide, had a significant impact on profit margins. So starting at the gross level, we saw a 370 basis point drop in the gross profit margin, primarily due to a drop in capacity utilization across most of our manufacturing facilities, which is something I will touch on in a bit more detail later in the call. There is also a component of this that reflects some provisions for edged raw materials. So essentially where the customer has postponed the order and for that reason we're provisioning for these raw materials. But that is something that we would expect to see reverse in future quarters as well. Nonetheless, in this quarter, the drop in gross margins did have a corresponding impact at the operating profit level, which you can see here, which contributed to an operating loss during the quarter. In addition to the drop in gross margins, distribution costs also did remain relatively elevated during the quarter, though I would say that they were down quarter on quarter as a result of a reduction in spending on air freight, and that is something that we would expect to see continue over the coming quarters as well. Finally, at the PAT level, we posted a 1.7 billion rupee loss, with kind of two additional drags worth noting there. The first being the increase in finance costs arising from the rise in global US dollar borrowing rates, as well as the increase in income tax expenses, which is as a result of the hike in corporate income tax rates in Sri Lanka, and also an associated deferred tax impact arising from that as well. Nonetheless, it's important to highlight that despite the very challenging quarter, our balance sheet does remain in a relatively robust position, with the net debt to equity ratio at 1.8 times at the end of December, which compares to 3.8 times at the end of December 2021. This is also a fairly similar level to what we saw in Q2 as well. Moving on to the next slide. I won't dwell on this too much because this primarily summarizes the key drivers of the performance I just mentioned. However, I would draw your attention to the chart on the right-hand side, which we have shown over the last few quarters. And this shows our split, the split in our revenue by country of manufacture. Right, so the inside ring shows the breakdown for the third quarter of the past financial year, and the outside ring shows the split for the quarter that we just completed. So the key kind of message coming off this is that we have seen a significant growth in the contribution coming from Egypt. And that reflects a couple of things. That reflects the increased ramp up coming from that facility, but also a continued demand for Egypt as a nearshoring solution for our customers, which is something we look to see continuing in the future, and is something I'll touch again also in a later slide. So moving on to kind of put the quarter performance in a bit more context. The chart on the left-hand side shows quarterly group revenue, while the chart on the right-hand side shows quarterly operating profits over the past 2.5 or so financial years. So this demonstrates that the drop in revenue in Sri Lankan rupee terms was still quite significant, also in quarter-on-quarter terms at about 20% as well. The operating profit chart also demonstrates the impact that's had on operating profits and how that compares to our recent performance, with the really important driver being here the decline in gross margins was a reduction as a result of the reduction in capacity utilization across the manufacturing footprints, which I'll go into a bit more detail on this slide. So the chart on this slide is intended to give some additional perspective on the shift in our capacity during the quarter. As a labor-intensive industry, there is not a straightforward means of calculating our capacity utilization. It can vary quite significantly. But what we have shown in this chart is produced standard hours, which is essentially calculated based on the clocked hours from employees directly involved in production, as well as the efficiency rate of production, and is really the key determinant of our maximum capacity at any one time. And what I'm showing on the chart is a comparison between our standard hours produced in Q2 in the dark blue bar and in Q3 in the light blue bar, and then showing that split across our countries in manufacturing as well. So what you see at the group level is there was approximately an 11% quarter-on-quarter reduction in produced standard hours, and that's coming off that drop in demand that we saw in the quarter. That is primarily concentrated in Sri Lanka, you see, with a smaller drop also occurring in Kenya. However, like I mentioned before, and you saw on the pie chart where the contribution of Egypt has increased, we saw increasing standard hours in Egypt, and that is again coming off the increase in capacity in that factory, and also the continued demand we're seeing for that nearshoring solution that Egypt offers. The rise in standard hours for Egypt is more reflective of a drop in production there earlier in the year, but nonetheless is still encouraging for the long-term proposition that we have there in Ethiopia as well. And in terms of the steps that we took during the quarter, we were quite proactive in kind of managing overheads and capacity during the quarter to deal with the drop in demand. And so the most important measure that we took was in December, we took the decision to amalgamate two of our manufacturing facilities in Sri Lanka. They're both very close to each other. So in terms of amalgamating them, we can reduce the overhead costs of operating two factories in a similar location while maintaining production at around the same level. So that will also reduce our total number of factories in Sri Lanka from 7 to 6 as of now. So that took place in December. So that's also the impact on cost we're going to see really from Q4 onwards as well. And as a final point on the quarter, so this is to give you an idea of the year-to-date performance. So in the blue bars, I'm showing the US dollar revenue, not the Sri Lankan rupee revenue, performance in the first 9 months of the past 3 financial years. So if we look at the right two most bars between the first 9 months of this financial year and last, we still have seen a slight increase in revenue. It's only about 2.3%, but still looking fairly resilient year to date. Where we have seen a drop is the impact of the Q3 performance on year-to-date profit margins, which is something that we will be seeking to mitigate as much as possible in the fourth quarter and being supported by some of those cost and capacity management measures that I just mentioned. So I'll go on now to talk in a bit more detail about the outlook. I think in summary, it's not as bleak as we thought it could be, and we are actually seeing tentative signs of stabilization in the economic outlook for our key markets. So that's coming off the drops of inflation. We've seen significant declines in energy prices in Europe and North America as well, and still seeing fairly resilient labour markets in those economies as well, which is suggestive of a more resilient outlook for consumer spending overall. And we have seen that to some extent reflected in our order book going forward. And also what you'll see is some of our retail brands, their results have been a bit better than expected as well. Though I have to really caution here that the picture still remains quite uncertain. It's very kind of mixed signals coming off the outlook for demand. So while we're currently seeing more positive signs going forward, there is the most significant risk is that is not sustained and we see a further downward leg in demand. So something we'll be watching very closely. And I think either way, we're very focused on ensuring that we're well positioned to take advantage of that future recovery in demand as and when it does happen. And also we intend to remain very agile as the operating conditions evolve and take the decisions to ensure that we drive a return to profitability in the short term, essentially regardless to a large extent to how the operating environment evolves as well. I'll come on in the next slide to talk a bit more about the kind of specific areas we're focusing on. But just before we move on, just a couple of other risk factors I would flag up for the coming quarters. Of course, one major one would be further increases in global interest rates, which is something we've seen have an impact in this quarter. Of course, it does look now that we might be reaching the top of some of those tightening cycles, but if inflation does not come down as quickly as expected, we could see further unexpected increases there. And as well as we also are looking at potential economic policy shifts in our key operating markets. So we've already seen a number of them in Sri Lanka, including the increase in corporate tax rates. But across our operating countries, all of them are in or seeking IMF programs. So we are watching very closely there for potential policy changes that may result and how we can mitigate their impact on us. I think the final point to mention is that because of the challenging global operating environment, there is a potential for increased financial strain among our customers, although this is something that we watch very closely. We do regular monitoring of, and is not something we're unduly concerned about because we very strategically chosen our customer mix partly on this basis. But the additional thing we are seeing is a lot of changes in leadership and strategy among some major retail brands as they seek to adjust to the new operating environment. So there's also that potential for shifts in business strategy that we'll need to adapt to. And that's really where that agility comes into play. And as a final slide, which I'll spend a bit of time on, is really kind of the key pillars of our focus for navigating through this period. So the first, of course, being driving a return to profitability. So we will see the positive impact of some of the cost reduction measures we took in Q3 coming into play in the fourth quarter and beyond. Excuse me. As well as we should see, and we expect to see a reversal of some of those aged inventory provisions that were impacting P&L in Q3, and will both be supportive of the bottom line. In addition to that, we should see the continued focus on operational excellence and SAP implementation are also expected to bear fruit in kind of managing costs in the coming quarters as well. And I think a key takeaway would be that given the uncertainty in the operating environment, we are remaining quite agile to how we look at mitigating any cost or capacity changes in future, and will continue to be so in the quarters going forward. On the demand side, it's really going to be about focusing on consolidating what we believe is a very strong value proposition. So maximizing the benefits of our unique country footprint and the continued interest in Egypt, which is something, as I mentioned, has been relatively strong throughout this period. In addition to that, we are taking a very proactive approach to winning additional business by really leveraging our strategic customer relationships and really aggressively going after additional business and focusing on a range of distribution channels, which kind of mitigates to some extent the risk in the operating environment. And the final leg of this is really continuing to seek new opportunities to strengthen our value proposition as we go forward, be that from a capability or a footprint standpoint, to ensure that as demand does recover, that we are best placed to take advantage of that and win new business because we have that offering that customers want. So that's really the kind of high level that we're talking about for the next couple of quarters, which we'll be happy to go into in more detail in the Q&A. The final couple of slides are on our social capital approach, which I won't dwell on. We will share this presentation with all participants after the call for you guys to go through in detail. But it would highlight that all our CSR projects are continuing. Key highlights from the third quarter was that we rolled out in greater detail our scholarship scheme, which is Hela across all our manufacturing facilities in Sri Lanka, which is a collaboration with one of our major customers, Tesco. In addition, we kicked off the GEAR program, which is the collaboration with Better Work, which is an ILO and IFC initiative, aimed at increasing the number of females in management positions. So those are kind of two relatively new initiatives which we took forward in the third quarter. We'll continue to implement currently. So I'll leave it at that for the presentation, but we can now move to the Q&A section. So if you do have any questions, feel free to write them in the Q&A box. You should also be able to raise your hand, and we will unmute you at that point to ask your question. So we'll give a couple of minutes for you guys to put in any questions, or feel free to raise your hands. So one question that's just come in is on distribution costs, and can you shed some light on the sharp increase in distribution costs? So I think, if it's okay, I'll give that one to you.
Sure. So there's a combination of factors that affects the distribution cost for that quarter. One of the largest contributors is the recognition of distribution costs along with the revenue recognition. So in this one particular case, which is stemming from actually a production delay that happened between Q1 and Q2 that was shipped in Q3. So along with that sale, we've had to recognize that cost of that particular air freight as well. This is still stemming from that impact we had early on in the year. But I think what we can say is that everything associated to that has been completely now been fully recognized in our P&L and will not be carried forward for any of the future quarters.
Thanks, Talanka. Okay, feel free to send any further questions in that you guys may have. We'll give you a couple more minutes to send in any other questions before we close up. One more question from Hassan. What is your expectation on the order book in the next 2 quarters? And in what region do you expect the order pickup to come first? I'll let you take that one as well.
Right. So, I mean, we're quite optimistic as far as the outlook is concerned. From Q3 to Q4, which is the quarter we are in now, we're seeing an uptick in both the production produced hours and also the sales aspect as well, even though February is a shorter month. Q1 and it's too early to quote on Q2, but we are seeing a good positive trend on Q1 where almost all of our facilities are running back at full capacity, barring one. This is not because of the facility or the country in general, but to the customer and the sort of product category that we are servicing. We are seeing that the European market is lagging behind more than the US markets. So Hela overall being a more US focused entity, we are seeing a recovery faster than, I guess, some of the other players who are more focused on the European markets. But that said, we have one cluster which is heavily focused on the European, that is our kidswear cluster, is almost 90% plus exposed to the European market. So that's where we are seeing the hit really coming in, but we've got mitigation measures that's come in place, one-off sales boost initiatives that have materialized, certain speed proposals that we put in, and with disruption coming in some of the other sourcing markets in East Europe, we see there's been some initial inquiries to kind of pick up some of that disrupted orders. So there is a lot of levers being worked on, and hopefully we'll see that trend continue in the Q2 and subsequent quarters.
Thank you very much, Talanka. One more question from Hassan. Have you made any price changes in the last quarter? How will the pricing pressure from global brands evolve in future?
There is, I'll take that as well. I mean, there is significant pricing pressure. I think this is probably one of the first few instances, at least in the last decade or so, where the industry has faced this level of open capacity globally. So what this has resulted in is that a lot of the players across all markets are really sharpening their pencils at quoting prices to either maintain their existing programs or to win somebody else's. So we've had to kind of do the same. We are seeing pricing pressures ranging from anywhere from 5 to 15% on existing programs and new programs. But that said, there is also an easing in the commodity prices. Freight rates are down, cotton prices are down and settling. So there is opportunity to work through your supply chain and take waste out of your entire end-to-end value stream and remain similar margins at the end of the day. There's a lot of work involved in achieving that, in getting to that point, but it's not impossible. At the same time, we've also gone through, like Adam mentioned, major overhead controls and reductions, analyzing our entire operation and seeing where we can consolidate, centralize, and unlock value.
Thank you, Talanka. So another question in relation to capacity utilization, which we also touched on, is more generally what is capacity utilization like? How is that impacting the break-even point?
Sure. Break-even points for capacity utilization, it's hard to kind of have a number because it really comes down to your contribution margin on those particular loading. But generally, around 90%, 85 to 90% would be your break-even target, assuming we maintain the same contribution margins that we've experienced in the last few quarters.
Okay, one more question we had is, can we shed some light on the leverage position and any plans to improve the situation, and also what is the mix between Sri Lankan rupee and US dollar borrowing?
This is the first. The first question on the LKR versus USD borrowings. LKR is a very small component of our total borrowings, less than 5%. It's predominantly the USD borrowing that we have. In terms of reducing leverage, it's a combination of a couple of things. There is certain facilities that we're obtaining for our receivables, which comes with the insurance component as well. So the moment those kind of facilities are on board, in fact, they're already onboarded, you will see the outcome of it in Q4, where you'll see the debt levels coming down, because to the extent of us being able to factor those receivables on an NRIF mode, that debt component disappears out of our balance sheet. And apart from those specific finance initiatives itself to bring the debt down, it's also about conserving cash or generating more cash through our operational improvements. So working capital is an area that we're focusing on quite significantly. In fact, if you look at our operating cash flows, the statement this year versus in the past, you'll see that there's an improvement on the working capital side. So that is the internal generation of cash that we're focusing on to further reduce our debt level. So it's a combination of all put together, certain initiatives on the finance side to better have a better debt portfolio that reduces our debt levels. And from the business side itself, generating more operating cash flows by reducing working capital that enables us to retire some of our existing debt. But I would just also go back to a point that Adam mentioned at the very beginning, that our debt levels have been nevertheless continuously improving, and the target that we set out for ourselves pre-IPO that have been achieved and marginally improved also beyond that.
Thank you, Louise. Okay, if there's no other questions, we'll give one more minute. You guys send in any further questions. I do see one comment that a few slides might have skipped in the presentation. We did cover most of them aside from the environmental and social initiatives, but we will be sending out the deck after the call. And if you do have any questions, feel free to reach out to us over email. We'll be happy to discuss any points with you guys in further detail. So one final question, I think, is what is the percentage contribution of PVH to overall revenue, and what is the status of PVH's order book?
Right. So within PVH, there's two entities that we work with. One is PVH, the US component, or the North American component, and then PVH Europe. Combined, it's a little over 50%. Is our total exposure between both entities. These two entities run very independently from each other. So we do treat it as two separate customers. The status of PVH's order book, it remains fairly strong still, of course, down from last year. But like I said earlier, the US component is holding forth, whereas the European component is being challenged. But on that side, on the European side, we are breaking into new categories and we are also exploring other opportunities where PVH as a whole is internalizing some of the business which they had earlier licensed to a third party. So with that internalizing, that opens up the opportunity for us to kind of take part in absorbing it into our portfolio. So there's a couple of initiatives even within the PVH side that we're trying to do to risk mitigate any loss, any potential drops in revenue, and also to see if there's any potential upside that we can capitalize on.
Thank you very much, Talanka. So I think with that, we'll bring it to a close. Thank you very much, everyone, for joining. And as I mentioned, please do feel free to send in any questions or emails that you guys may have arising from today's call. But with that, thank you very much again for joining today's call, and I wish you a good rest of your day.
Thank you.